Welcome to InvestorHubX.com. Rising wedges look bullish, falling wedges look bearish. But in reality, they do the exact opposite. And if you don't understand this, you'll keep buying the top and selling the bottom. In this video, we're going to cover what a rising wedge is, what a falling wedge is, real market examples. Let's get started. Let's start with a rising wedge. A rising wedge is a chart pattern where price is moving upwards, but at the same time, the range is getting tighter. This means both the highs and the lows are increasing, but they are getting closer together. At first glance, it looks bullish. Price is going up, higher highs, higher lows. But here's the problem. Buyers are getting weaker. What's actually happening is this. The market is still pushing higher, but each push is smaller than the last. Momentum is slowing down and the trend is running out of energy. This is where traders get trapped. They see price going up. They think the market is strong, so they buy near the top. But instead, the market reverses, and they become the liquidity. Now, let's look at the falling wedge. A falling wedge is a chart pattern where price is moving downwards, but at the same time, the range is getting tighter. This means both the highs and the lows are decreasing, but they are getting closer together. At first glance, it looks bearish. Price is going down, lower highs, lower lows. But here's the problem. Sellers are getting weaker. What's actually happening is this. The market is still pushing lower, but each push is smaller than the last. Momentum is slowing down and the downtrend is running out of energy. This is where traders get trapped. They see price going down, they think the market is weak, so they sell near the bottom. But instead, the market reverses, and once again they become the liquidity. Let's take a look at this on the 4-hour time frame on Coinbase. On this chart, we can see price moving upwards, forming higher highs and higher lows. At first glance, this looks like a strong uptrend. But if we zoom in, we notice something important. The highs are getting closer together. The lows are also getting closer together. This creates a tightening structure, which forms a rising wedge. When a rising wedge breaks down, it often marks a transition from an uptrend into a downtrend. Now, let's take a look at this on the daily time frame on Dogecoin. On this chart, we can see price moving downwards, forming lower highs and lower lows. At first glance, this looks like a strong downtrend, but if we zoom in, we notice something important. The highs are getting closer together. The lows are also getting closer together. This creates a tightening structure, which forms a falling wedge. Here, we draw the resistance line across the lower highs and the support line across the lower lows. They are converging towards each other. Now, this is where most traders get it wrong. They see price going down and assume the market is weak. But in reality, momentum is weakening. When this falling wedge breaks out, it often marks a transition from a downtrend into an uptrend. To summarize, a rising wedge forms when price is moving up in a tightening range, but momentum is weakening and it often breaks down. A falling wedge forms when price is moving down in a tightening range, but selling pressure is weakening and it often breaks to the upside. In both cases, the market looks strong or weak on the surface, but underneath, the trend is losing energy, and this is where most traders get trapped. They buy near the top and sell near the bottom, right before the market reverses. So remember, rising wedge is typically bearish. Falling wedge is typically bullish, and both are powerful signals of a potential trend reversal. If you found this lesson helpful, please give the video a thumbs up, subscribe to the channel, and turn on notifications for future lessons. I'll see you in the next video.